give everyone the rest of your bio, right, your resume, I think it's so important for people to know about you that before you got into the policy and research economic side of central banking, the Kansas City Fed, you were a bank examiner, and you shut down hundreds of banks in the early 80s when U.S. banks got in trouble. One of the first big bailouts happened then.
Yes.
It really gave you a perspective on all of this that I don't think everyone shares.
Well, I did go through those times, and they were periods where asset values went up dramatically, and people felt that they should leverage and take advantage of this, and they did those things. And then when the economy turns, it's always wonderful. Leverage is that wonderful thing when everything's going well, but when it turned against them, there wasn't sufficient capital in the system. They hadn't really underwritten their loans and their other assets well, and so we had literally hundreds of failures just in our region, and well over 1,000 failures nationwide. So it has its downside as well.
And as you left the Kansas City Fed, you went on then to really focus on this in your work at the FDIC. Janet Yellen is giving her opening remarks to the Kansas City Fed Symposium. The Fed chair starts it off every year. And what we know so far is she's going to speak about financial stability. She's not going to talk about inflation as the topic necessarily. She may mention it. Why do you think she chose that topic?
Well, only she can answer that question, but I'm really glad she did raise it as a topic, because we're right now in a pretty encouraging economic set of circumstances. Profits are up at banks. There are going to be records. And it's in those times that banks tend to make their mistakes. They tend to think that everything will only go well. They tend to want to increase their leverage. That is, they want to borrow more money so they can make more money. And it all sounds good. But as the economy then slows later, they have these very significant leverage problems, and then we have a crisis. That's the 2005-2006 period, and it's the 80s period. It does tend to repeat itself. So now's the time to be thinking about financial stability, because now we're making our mistakes that I think we need to be aware of, especially supervisors. This is when we have to be really on alert.
Well, what about capital standards? They're higher than they were. We know the banks are holding more capital. Isn't that enough? We know the Fed has some great macro-prudential tools to keep an eye on those banks, not let them get too far off the rails. Why isn't that enough?
Well, in the sense that you think capital is enough, it's better than it was in 2007, but that's not saying much, is it? We had a terrible crisis. They are at, if you look at real loss-absorbing capital, it's 6% of their assets. So they have that margin, that very small margin of error, and now they want to actually make it more. And think about it, 6% is like an 18-to-1 leverage ratio. They want it to be higher, 20, 25. When we had this crisis, it was around 25 and 30. So we're taking on leverage so we can make it short-run profit. Let's start thinking a little bit longer run. Let's think about the whole cycle. And capital is important. Supervision is important. But bank management, bank capital, and strong rules of the road are what will keep us able to get through any downturn in the future. And we need to focus on that.
What's the implication for Fed monetary policy, for interest rates? Is that playing a role in your concern about potential financial instability?
Of course it is, because we've had nearly a decade of very low interest rates. And the effect of that has been to increase asset values. We've wanted to go forward with that. And with those low interest rates, we've noticed that banks have increased their maturities on their assets. So they are now making loans at reasonably low interest rates for longer periods of time. So now let's say we get into a cycle where interest rates are going up. Those assets will be under pressure. Those banks will be under pressure. Their capital will be under pressure. They need to be prepared for that. That is a possibility. Not one I want, but they have gone longer on their balance sheets in terms of maturities, and that has implications for the future. Monetary policy matters. It has affected, and that's when supervision has to be on the alert.
Would a rate hike at the Federal Reserve this year send a signal to the banks?
I think everyone knows that we are at this very fragile equilibrium, and then rates have to become, people like to use the word, more normal. So I don't think that's going to be a surprise. And I think their program is to do it slowly so that you can absorb that. But it can't be so slowly that the banks take it for granted and continue to extend their risk on their maturity side. They need to be thinking a little longer term themselves. And I think that's something we can talk about, and I think something they need to be aware of on their own.
So banks say that, hey, Tom, we learned a big lesson. We have compliance like you can't believe. We measure risk day in and day out. And, you know, we could actually lend more. Sure, we're doing well, but we could lend more and help this economy grow if we could loosen up some of these regulations as the president and the Congress is suggesting, at least the Republicans in Congress.
Well, they've been using, the banking industry, the large banks particularly, have been using that as an explanation for why we ought to allow them to lever up, to lower our capital standards. And I noticed in this last CCAR test, they're proposing that they pay out more than, as an industry, 100% of their earnings. And I've argued and said, well, wait a minute, what if you kept half of those earnings? You could lend more. You could actually promote growth in the economy. So why don't we think about it from that perspective? Because capital is not an idle reserve. It's not sterile. It can be deployed, earn returns, and actually boost profits in the long run, and give you a safer banking system on top of it. I think that's a very good combination they ought to be thinking about as well.
Quick final comment. What would you say to President Trump and the Republicans in Congress about their proposed legislation? Well,
I think that we need to look at it all, I'd say, but I would be very careful at each proposal, because many of those proposals are coming from the industry. Their perspective is different than the public's perspective, so let's keep that in balance. I think that's a warning from Adam Smith, who's supposedly the father of economics, and I wouldn't want them to forget that.
Okay.